Good afternoon, everyone. Important topic for quite a few of us that have been working with a lot of foreign buyers over the years. Things keep changing and things keep getting tweaked up. And, David, I feel there's more and more legislation and other deeper topic that realtors need to know about. I know one of our clients actually had this issue where they had shared with the lawyer that they were using, not Kerman's, of course, and they used their ID from they were permanent residents, but the ID that they used was another passport from another country, and they got a note from CRA that they owed X amount of taxes. This was before I think the ban was in place. So, there's so many things that realtors need to be aware of. And they repeatedly ask me the same questions. Our broker, especially, we have a lot of realtors that are working with international investors previously, and things have changed so much. So super interesting conversation to be had, and I look forward to it. So over to you, David.
Okay, thanks, Sabiha. Yeah, and it's one of those pieces of legislation that they've already done a couple amendments on. That just creates more confusion. They've extended it. We'll get into that and go through some of that. And you got to
Sure.
pay attention to penalties that are in place as well. There's potential risk for a lot of people on that. So we'll get into all that. We're going to start though with the Toronto vacancy tax. We got a two-parter here. A lot of information to pass on, but some of it, we've done in previous sessions, but I want to just go over the stuff. There's been some changes to it, so we'll get through both of them. Apologize in advance if I'm going to talk quickly, but let's get going. We'll skip through the introductory slides. These are all things we've had discussions on our David and David podcasts about these issues in a few sessions. You can look those up and get some more in-depth discussion and get David Gorski's view on some of these as well. So we'll start with the City of Toronto vacant home tax. Okay. Now, first thing I should say, this has nothing to do with another tax we're not even going to talk about today, which is called the underused housing tax. So the underused housing tax is a federal tax that's applicable in certain situations where the federal government's trying to do their own version of a vacant home tax, but that's a separate issue. That's not a tax that really affects your closing transactions. It's a filing requirement that people have to do at the time they're filing their income tax returns, and they may or may not have to file something to satisfy the government that they're not subject to that tax, or the tax might be payable depending on whether they fit certain definitions. But that's we don't look at that on a transactional basis when we're closing transactions. So I'm not going to talk any further about that one. I don't want to confuse you, but just know that's a different one. This is the City of Toronto's vacant home tax. So it's only applicable to people that live in that own real estate in the City of Toronto. So if it's outside the City of Toronto, if you're in Mississauga, doesn't apply. Your Richmond Hill doesn't apply. Okay, it's just City of Toronto. So just keep that in mind. So this goes back to 2021 when they started thinking this is a good way to achieve a goal. And the goal at the time, what they were trying to achieve is there's a housing shortage. So the stated goal at the time is we want to encourage people to not leave their places vacant and to put them up for rental or sell to somebody else that'll use it, but it's not good if there's a whole bunch of properties that are vacant. And I don't think they even knew how many properties were vacant, but they decided to do that. And so they'll tax any property that is vacant in certain situations. And then they built in a bunch of exceptions and things like that. So we'll get into that and look how you may or may not have to pay it. And then the other part of their thinking at the time was, well, hopefully we encourage some people to put their houses up or their condos or whatever so they don't remain vacant so people have places to live. But if they don't and they pay the tax, we're going to get all this revenue and we can use this revenue towards building affordable housing and doing certain initiatives. So that was sort of the stated goal. Whether they've achieved any of those goals, I don't know. I do know for certain that they've achieved a lot of confusion among City of Toronto homeowners, and they've gone through quite a process in recent weeks, even of having to backtrack on things because they issued a bunch of homeowners some outstanding bills and penalties and interest charges for not filing properly, and it's been an administrative nightmare. And they've had to claw back a lot of those because they weren't improperly issued. But anyways, I'm going to go through so you understand the basics of how this is supposed to work, and then we'll see. So this came in to force January 1, 2022. And so the tax was supposed to be payable starting in 2023. So it was like a year ago, and now we're already at the point where if it was vacant in 2023, then you were supposed to have paid any taxes that might have been owing for this in the early part of 2024. So what is the vacant home tax? So first of all, this applies, it's for residential properties. It's got nothing to do with any commercial properties or anything. So every owner of a residential property in the City of Toronto is now required to file an annual declaration with regards to their occupancy status of their property for each taxation year. So a calendar year by calendar year basis. You have to say, I owned the home in 2023. I lived there myself, no tax payable. But you got to do a filing. So no matter what, you have to file. And if you don't file, there are certain penalties and repercussions that we'll get into. Okay. So this started for the year 2022. So you had to do a filing for how your property, your residential property, was used in the year 2022. And they were going to tax on any properties that are vacant, or if they're deemed vacant under this law. And then if there's a tax due, it has to be paid in the following year. So if a tax was due for the year 2022, that had to be paid in 2023. If it was due for the year 2023, it has to be paid in the year 24. So you have to look at this on a year by year basis. Every year you have to look and see, was it vacant? Was it not vacant? Do I fit under an exception, et cetera? Because you're going to file, you have to do a filing. That's what he has to do. So a property is considered vacant if it wasn't occupied by the owner or by somebody else that's deemed to be a permitted occupant, and we'll get into all that, as their principal residence, or was unoccupied for a total of more than 6 months during the previous year. So that means that the owner could be occupying as a principal residence, but they weren't there for more than 6 months in the previous year. So therefore it's vacant. So they would have to pay that tax unless they fit under one of the exemptions. So the amount of tax is not small. It's determined to be 1% of the current value assessment of the property. And they look at the most recent assessment rules to figure these things out. So if the tax is payable, they look at the prior year's assessed value of it, and you're paying 1%. So it's not an insignificant amount. So on $1 million property, it's a $10,000 tax. So it's not something to sneeze at for most of us. So we've got to hopefully not pay the tax because it's not applicable, or there's an exemption. And in some cases, the tax will actually have to be paid. So we got to look at that. So like any legislation, there's a bunch of defined terms in here that we have to look at carefully, and we have to look on a case-by-case basis to figure out who fits under what definition of what property. So the first one is an owner, and for this legislation, the purpose of this law, the owner is the registered legal owner of the unit, of the whatever is considered the residential unit, the registered legal owner. So if I own a property in trust for somebody else, but my name is on title because I'm the registered owner, then I'm the one that has responsibility for this, not the beneficial owner. It's the registered owner. And I mentioned before, it's only for residential properties. So it's a parcel of property or a portion that's classified in the residential property class based on the assessment rules at the time that these things have to be paid. And there's a definition of residential unit, which is a residential property that comprised of one or more self-contained units. And then, of course, we need a definition for self-contained units, which is a dwelling unit, which includes a dedicated washroom and kitchen. Okay, so there could be more than one self-contained unit in a particular property if there's more than one, if each one has a separate dedicated washroom and kitchen. So when is it considered vacant under this bylaw? A residential unit is vacant if for more than 6 months during the taxation year, so that's the calendar year, no self-contained units are either the principal residence of the owner or other occupants, or occupied for residential purposes by one or more tenants for at least 6 months of the year. So again, we're looking at facts all the time in a particular calendar year to determine whether or not something is considered vacant. Okay, vacant if more than 6 months in a year. So we're looking at 2023 last year. During that year, 2023, was it vacant for more than 6 months? Or was it occupied as a principal residence by the owner or somebody that's allowed to be there as an occupant, or by tenants for at least 6 months in the aggregate? Doesn't mean consecutive, but in the aggregate. So you have to look factually who was there, who lived there to make this determination. Now, a property will be deemed to be vacant, whether it was vacant or it wasn't vacant. A property will be deemed to be vacant if the owner doesn't complete and file the declaration of occupancy status, or if the owner fails to provide any information or evidence demanded by the city to determine the occupancy status. So everybody has this obligation to file. If you don't file, then they can declare that your property was vacant. Whether or not it was or it wasn't, they're going to deem it vacant, taxes payable. Okay. If they're looking into the filing that you did and they've asked for certain backup information or evidence to prove that there was tenants there for more than 6 years, or prove that there was some permitted occupant there for at least 6 months of the year, and you don't provide that evidence, again, they can deem it to be vacant because you didn't comply with their demands to produce the evidence that they need to make the determination. So you got to be careful in what you do, and you got to be timely in your supporting documents and provide them when you have to provide them. So the declaration itself has to be done by February 2nd in the following year. So February 2nd, 2024, a couple months ago, you'd be filing a declaration for the 2023 year. Okay, the year ends December 31. Now you got a month and 2 days to file your declaration for the previous year, how the property was used for that previous year. And if there is a tax payable for 2023, that would have had to have been paid by May 1st of this year. Okay, so those are important deadlines to note. February 2nd, and it's going to be every year until they abolish this law. February 2nd, you got to do your filing. And if there's tax payable, you got to pay it by May 1st. Those are the dates to keep in mind. Okay. Now, there's different types of occupancy status that has to be considered. So I just want to go through each of those a little bit. The first one is a property being occupied as a principal residence by the homeowner. So that's pretty basic. The owner is living there. They conduct their daily affairs there. That's where their bills go to. That's where their mail goes to. And an owner can only have one principal residence. So they can't pretend that they got more than one principal residence. There's evidence that'll have to be produced when they do random audits with these filings. And they have to have that type of evidence to back up that they only have one principal residence. And here's some evidence. This is where my mail goes. This is where the bills go. This is where I conduct all my affairs, etc. Okay. Now, an owner can leave, can travel for work, for pleasure, do other things, but they may have to explain some of that if they're audited and everything. That it still has to be clear that this is where they're living as their principal residence. The second type of occupancy status is a property that's occupied as a principal residence by a permitted occupant. So that's someone that's authorized by the owner to use it as their principal residence. So a permitted occupant can be a family member or a friend. Like, I own the property, I'm not living there. I have a principal residence somewhere else, but I'm allowing my daughter to live there as her principal residence, or I'm allowing my friend to live there. She's a permitted occupant, and that permitted occupant has to be living there and using it as their principal residence. Okay, so this category doesn't include tenants. The third category is the tenant category. So here, where the property is occupied by someone that has a written tenancy agreement for a lease that's at least 30 days. Okay, so this is a third party tenant under a written lease for at least 30 days. They could be considered someone that's occupying it, and it's a tenanted property. And obviously it has to be occupied by for residential purposes, not because they're using this condo somewhere to run a business out of. It's got to be residential purposes. And for it to fit under this, it has to be occupied by one or more tenants for a total of 6 months throughout the year. So I could have 6 different people under written leases that each occupied it for at least 30 days, as long as the total during the calendar year 2023 was 6 months, then it was a tenanted property occupied by tenants during that calendar year. So you can't do 5 months one year, 1 month the next year. That doesn't count. You look at each year, and if it was only 5 months in one year, one calendar year, then it'll be considered a vacant property, even though there was a tenant in there for 5 months, and the tax will be payable. The fourth category is that it's vacant, but there's an eligible exemption. So there are certain exemptions that are available. And I'm going to give you a little more detail on the exemption. So it could be vacant with an eligible exemption, and the exemptions are basically, the owner dies, the registered owner dies, during the year. There's substantial renovations and requiring people to be out. The principal goes into some care facility. There was a transfer of legal ownership during the year, or there's an occupancy for full-time employment or by court order. And I'll go through a little more detail in a minute. The fifth category is that it's vacant or deemed or determined as vacant. So it can be declared as vacant by the owner. It can be deemed to be vacant if the owner doesn't make the declaration. Like I mentioned before, even though it may not have factually been vacant, it'll be deemed to be vacant. Or the property can be determined to be vacant after there's an audit, and on review, they're not satisfied with the evidence provided, and they determine that for the purposes of this law, they're going to say it was vacant. And if it's deemed or determined to be vacant, then the tax will be payable. So I just want to run through a little bit more on the exemptions that are available. So the first one is the death of a registered owner. So good news, bad news. The good news is the vacant tax won't be payable. The bad news is you died. So you're qualified for an exemption. So if someone dies and it becomes vacant for that reason, the tax won't be payable. So obviously this will be dealt with by the estate trustee, whoever's looking after the property. They'll want a copy of the death certificate to show what happened, and they're not going to come after the estate to pay that tax. The other exemption is that's a fairly important one, is there's been some repairs or renovations. So, and it's an easy scenario to see. People have to move out because there's some big renovation going in the house. Sometimes they're out for an extended period of time. So there's certain criteria that have to be met and evidence that has to be provided, and there could be an exemption available. So the occupation normal use is prevented by the repairs of the renovation. Permits had to be issued for these repairs and renovations, and the city's building official is of the opinion that the repairs and renovations are being actively carried out without unnecessary delay. So they're going to want to see evidence for all this. They're going to you have to provide a description of the project that's preventing it being occupied. They're going to want to see the building permits. They're going to want to have the building official attend and make an assessment of how long this should take or shouldn't take, and be satisfied that it's not that there isn't some unnecessary delay here. The third category of exemption is that the principal resident, had to go to a hospital, a long-term care facility, that type of thing, for at least 6 months during the year. So again, good news, bad news. The good news, you don't have to pay the tax. The bad news is you had to go to a hospital or a long-term care facility, but you get a break. If that's the reason that the place became vacant, and they'll need evidence of that as well, which will be a letter from a healthcare facility on their letterhead, and they'll be looking to make sure nothing like that is forged, and they'll check it out. The next exemption is a transfer of legal ownership. So if someone purchased the property in the previous year, and we're talking about 100% transfer of the property to an unrelated individual or corporation, so then there's an exemption available for that, and you'd have to produce a copy of the deed. The next one is occupancy for full-time employment, because the property is required for occupation for employment purposes for a total of at least 6 months in a tax year. And evidence will have to be provided for that as well, including a letter from the employer. So you might have an exemption there. And the last category was a court order. If there's a court order that forces or prevents people from occupying for whatever reason for at least 6 months in the year, then there's an exemption. Tax won't be payable because you're not occupying because of a court order. And you'd obviously have to produce the court order to justify that and provide some evidence. So to make the declaration, this part they tried to make pretty easy. It's not a complicated filing for anybody that has done it or helped anybody do it. There's an online portal, and it's checking off certain boxes and providing certain basic information. And for many people, it's just simply checking off a box that I occupied the property as my principal residence. That's it. You submit it and you're done. When you're getting into the exemptions, people have to be careful and look and make sure that their fact situation fits the exemptions, etc. It's intended that you can do this fairly easily on an online portal. I don't think there's too many lawyers that are being retained to do it. We get consulted on some of it because we get retained when there's some situations that are a little gray and they're not sure if they fit under an exemption. But for many people, they can do this on their own. When we get asked questions about it, we don't have a quick answer. We have to get a retainer and look at all the facts and information and ask the right questions before we can make a determination. So, that's the way we handle things in gray areas. But the intention is they were hoping that people would be able to answer this fairly easily and do it online or do it by paper. You can mail in, do a mail-in declaration as well. And payments can be done online. There's different ways to do it through your financial institution, mail in, etc. So there's information available, and it's not that difficult to do. What you have to keep in mind, though, is what happens when you don't do it. You don't do your filing, or you don't do it in a timely manner. They've imposed a bunch of penalties and fines. And interest on overdue taxes at a rate of 15% per annum can add up pretty quickly. If you don't make the declaration on time, there could be a $250 fine. And a fine of $250 up to $10,000 could be applicable if you're found guilty of any offenses for failing to make the declaration as required, or making false or deceptive statements, or altering, hiding, disposing of records, trying to evade payment, things like that, making false entries, omissions, willfully evading or attempting, you might not be successful evading, you may have attempted to evade paying the tax or comply with the bylaw. So you could be subject to a fine of up to $10,000. So don't do it. Okay. Now, even if it is filed, there will be reviews. They're looking at all these filings to check out, see if they're done properly, to see if they want to question some of the filings, which ones they want to do audits on, which ones they want additional information for, which one they want evidence for, and they can ask for all of that when they come back. And so there's assessments, there's supplementary assessments, etc. And they can go back 3 years. So you may think you've got away with something for a while. 3 years later, they come back and say, hey, we want to reassess what happened in 2022. So there's a built-in for that in it as well. And then they want everybody to keep their records and all their documents for at least 3 years, because there could be these audits or these further assessments being done. So you got to keep track of your stuff. If it was tenanted, if there was a renovation, etc., and you think you're fitting under an exemption and you're filing and you hear nothing, don't get too excited, because 3 years later they might come back and do an audit and say, where's the documents in support of the way you filed your declaration? So keep that information around, okay? Because there's a whole bunch of things that they could be asking for as backup for all this. So there's also a complaint and appeals system that's built in. If you disagree with what's happened, they've gotten a ton of people issuing complaints and appeals. And part of it, because there was a bunch of administrative errors that have happened since this came in, and they were, people had filed and then received notices that they didn't file and had penalties, and now they're clawing back and backing off on some of that. They've extended some of the timing requirements because they weren't set up to deal with it properly. So they're still in their growing pains a little bit, but if something is wrong, there is a procedure where you can complain, you can appeal. So there are procedures available for people that are being wronged or think they're being wronged by this. So the question you should be asking, because you're all real estate agents, is how does this affect our real estate transactions, or does it affect our real estate transactions? Like I mentioned before, the underused housing tax, the federal law doesn't really affect the transactions, but this one does. So we have to pay attention to this from a transactional point of view, okay? Because the non-payment of the tax can result in arrears. What should have been paid can be added to the property taxes, and that can be collected as part of the property taxes that go with the property. So if somebody had property was vacant, didn't pay the tax that was supposed to have been paid, that can attach to the property's property taxes, and some buyer that comes along and buys the property, unaware that this doesn't happen, now has just bought this tax problem, because that tax is payable, and if it's not paid, just like property taxes, they can put a lien, the city can put a lien on the property and ultimately sell the property to collect it the same way they would collect property taxes. So it's really important when you're on the buyer's side to ensure that these declarations have been filed by the seller, so there's no arrears. We want some evidence on closing that, or before closing, that there are no arrears. Declarations have been filed, no taxes paid, there's no arrears, no penalties, etc. Okay. When we do title insurance on properties in the city of Toronto, the title insurers are looking for evidence of compliance with the declarations and see if any taxes are payable as well. Okay. So don't forget, we've got this time period from January 1 till February 2nd each year when the declarations are supposed to be made. So if you're on a transaction that's closing during, or that you're negotiating agreement during that period, they may not have filed yet. And we want to know if it's after February 2nd, they should have filed, so they can make a clear statement. We either filed or we didn't file. But even before that, it may not have been due yet, but we want to know if they have filed or they haven't filed. So we've got to be paying attention to this. So if the transaction closes between February 3rd and the end of the year, the seller is still responsible for the previous year's taxes, because it was the seller that owned the property during the previous year. Okay, so if we're closing a transaction this year between February 3rd and the end of the year, it's going to be the seller that owned the property in the prior year that's responsible for the taxes. The buyer is going to complete and submit their declaration in the year in which the closing occurs. Okay, but they can use that exemption. One of the exemptions was there was a transfer of legal ownership, so that there's an exemption during that year. So they can rely on that, so they don't have to pay tax during the year, that vacant tax during the year that they closed the transaction. Okay, but we have to be asking the seller about the history of it. So we'd like to get the seller to provide a copy of their filing, what they did, and provide us with a statutory declaration that it was true and correct. It'd be nice to have that evidence before closing, so we know that it was filed and there's no taxes payable. So the lawyer that's involved acting for the buyer, wants to protect, we want to protect, and you as an agent want to protect the buyer as well. So we want to make sure that the buyer is not going to incur any of these liabilities because of this vacant home tax. So this can be addressed, and the best way to address it is in your agreements of purchase and sale by adding a clause of some sort, and I'm giving you an example here, that can be used in an agreement of purchase and sale. So in this clause, we have the seller providing a representation and warranty that the property is not vacant or deemed vacant under this law, and the seller has fulfilled all of their obligations under it. So to fulfill their obligations, they have to file a declaration, they have to pay any tax if there's any payable and any penalties. The seller further represents and warrants that the declaration required has been filed and there are no pending arrears, including penalties and fines, with regard to the vacant home tax. Okay, so at the very least, we want to get people putting some type of clause. I don't know, Sabi, if you've got that particular clause or some version of it.
So I don't have any clause in my Schedule A setup, and I was just thinking about this because obviously this is specific to Toronto.
Yes,
So
this is
maybe I can
Toronto
just
only.
yeah. So instead of adding it to because I have a set Schedule A for everybody to use, but I think this should be something that I can put in our brokerage clauses for people to be working in Toronto. This would be very useful.
Yeah, because any transaction where it is a
Yeah.
Toronto property, you want to get something like this in there. You want to at
Right.
least get,
I'll copy this if that's okay with you, David, and use
yeah.
it in
Also,
our
I can send you a PDF version
perfect.
of.
Perfect.
So,
Thank you so much.
okay, so these are some other ways how realtors protect their clients. We want the seller agreed to provide the following to the buyer as proof that the seller has fulfilled all their obligations under this law. So we want to provide a copy of the completed and filed property status declaration from the previous taxation year and a sworn declaration by the seller confirming that the latest declaration filed is true and correct. So we want to get a sworn document too from them, and that there's no arrears for the vacant home tax, or if there are arrears to be paid, they'll be paid and they'll provide evidence to us before closing. Okay. And then we want to go on another one. The seller agrees to indemnify and save the buyer from any liabilities, claims, expenses, losses suffered by the buyer as a result of the seller's failure to fulfill their obligations under this act. Okay, so we want them to provide us evidence that they've complied and reps and warranty they've complied and agree to indemnify us. And if they don't, or they balk at it, seller doesn't want to give that, that's telling us something. Okay, because if they have done their filing and there is nothing owing, they shouldn't have a problem giving us evidence of that, swearing a document to confirm it, and agreeing to indemnify us in case they didn't. Okay, because if they did, they've got nothing to worry about. So I encourage you to get that in there, and we'll get this language to Sabi and she can share it with all of you. Now, this is all City of Toronto properties only. Just so you know, there is another city in Ontario. Some people may not have never heard of it before. It's called Ottawa. And Ottawa has a similar law, a vacant home tax that applies if you're in the city of Ottawa. It's almost identical. It's very similar to ours. So if you happen to be dealing with a property in Ottawa, you have to pay attention as well because the same issues come up and you want to be satisfied there's no taxes payable there as well. Okay, so just be aware of that. But so far in Ontario, it's Toronto and it's Ottawa. Okay, if it's outside those cities, there is no vacant home tax. Okay, it's a city legislation. It's not provincial legislation. It's not a federal legislation. So now we're going to get into the next topic, foreign buyer ban. Okay, now foreign buyer ban is a federal law. Okay, this is the liberal federal Trudeau government that introduced this law back in June of 2022, and nobody understood what they were really going to do because everything that the basic drafting said everything will be explained more in the regulations, and the regulations didn't come out till December 21 of 2022, and this was supposed to come into effect 10 days later on January 1, 2023. So this created all kinds of confusion because no one knew what the rules were going to be. But anyways, it came into effect January 1, 2023. Then there were some amendments done a few months later in March of 2023 that changed some of it because really some of it just wasn't making any sense. So, and originally when this was introduced, it was supposed to be for a 2-year period starting January 1, 2023. So we'd almost be done with it, but they've now extended it, and this is going to continue till January 1, 2027, unless there's a change in government and the next government throws it away. But until that happens, this is in force until January 1, 2027. So this prohibits non-Canadians from buying residential real estate. That's the intention. Non-Canadians cannot buy residential real estate in Canada. Okay, that's the basic principle. Now, like all legislation, there'll be some exemptions. We have to look at the definitions, etc. Like the first thing we have to look at is what's considered to be a non-Canadian, who is deemed to be non-Canadian. So non-Canadians include individuals who are not Canadian citizens or permanent residents or a registered Indian under the Indian Act. So if you're an individual, you fit under that, you're non-Canadian. Foreign corporations are considered non-Canadian. So those are corporations that are not formed under the laws of Canada or a province of Canada. Okay, if you're an American corporation, you're a foreign corporation, you can't buy residential real estate in Canada. Okay, corporations that are based in Canada, that are privately held, not listed on a Canadian stock exchange or controlled by a non-Canadian, are also considered to be non-Canadian for the purposes of this law. And other foreign entities as well can be considered non-Canadians if they're controlled by non-Canadians, unless they're publicly traded entities. So a corporation that's publicly traded on a stock exchange is not considered a non-Canadian. Okay, so first place we have to look at is, with any potential buyer, will they be considered a non-Canadian under one of these definitions? And if they are a non-Canadian, they can't buy residential real estate in Canada at least until January 1, 2027, or until they kick out the government and put another government in that gets rid of this law. Okay, so there's a definition of control under the Act as well, because we're talking about corporations and entities that are being controlled by someone. So in order to determine whether it's a non-Canadian corporation or entity, there's a definite, we have to look at the control of it. So there's control is determined different ways. One is by equity ownership, where there's direct or indirect ownership of equity shares of at least 10% or more. It could be voting rights carrying 10% or more of the voting rights, or it could be a determination of control in fact, where there's direct or indirect control in fact through ownership, through an agreement, or something else that nobody has thought of, and they're trying to close off a potential loophole. So if someone's controlling, if it's a non-Canadian, the intention is there's a non-Canadian controlling an entity that would otherwise be considered Canadian and allowed, permitted, but if it's controlled by a non-Canadian, then it's deemed to be non-Canadian for the purposes of this act. So they're trying to close off everybody's potential creative ability to create loopholes here. Okay. Now, this applies to residential real estate, but not all residential real estate. Okay, so there's types of residential that fall under this. So it's detached house or similar building containing not more than 3 dwelling units. Okay, part of a building is a semi-detached row house, condo that's intended to be owned apart from any other city or building. So if it's residential and it contains more than 3 dwelling units, someone's allowed to buy it. Okay, so they're not prohibited, if you're a foreigner, from buying something if it's more than 3 dwelling units. Okay, and then there's also another exclusion that I'll give you a little information. If the property is not within either a census agglomeration or a census metropolitan area. So there's certain areas of Canada, and I'll show you on the next slide. This is confusing. I'm not going to go into detail, where they've sort of mapped out certain areas that they're saying this is not going to be applicable to. So if someone wants to buy a particular, and a lot of this is more rural, smaller centers, things like that. So they'll allow some foreigners to buy in certain smaller centers. They want to keep them out of the bigger centers. And there's a map, and you can see if you fit on the map, and you might be excluded from this law, depending on where you're buying, where the residential property happens to be. Okay, again, it depends on the fact whether you fit within these maps in one of these areas. Then they've also built in certain exemptions. Okay, and the exemptions would allow someone who would otherwise be considered a non-Canadian to buy a property if they fit under one of these exemptions. So the first one is individuals who purchased residential property with their spouse or common law partner if the spouse or common law partner is not prohibited under the Act. Okay, so if you have a spouse that's allowed to buy, they're a Canadian, then you can buy it with them as a non-Canadian. So the fact that you're a non-Canadian doesn't stop you and your spouse from buying the property. Okay, as long as one of you is. Another exemption is that you're a temporary resident in Canada under certain conditions of either being a student or a worker, and there's more detail that has to be determined whether or not you qualify as a student or a worker. And there's another exemption for others that are just prescribed by regulations, that it does not apply to them for things if you happen to be a refugee claimant fleeing an international crisis, if you're an accredited member of a foreign mission. There's other regulated exemptions for if you fall into one of those categories. The student one has other criteria that have to be met. And again, we got to look at each one on a case-by-case basis. There's no quick, easy answer. We got to look at what the actual facts are. They have to be enrolled in a program of authorized study at a designated learning institution. So not all learning institutions would qualify. The government sets out which ones do and which ones don't. They have to file income tax returns for each of the 5 taxation years preceding the year that they buy. They have to be physically present in Canada for at least 244 days in each of those 5 years. The purchase price can't exceed $500,000. I'm not sure if I come up with an example of anybody that I know that would actually fit under all of this, but like they're not making it easy, and you got to look at each person's situation. So if there's a potential that someone might fit under a student exemption, you got to look at the facts and go point by point and see if they fit through that. Similarly, if you're trying to qualify under the workers exemption, they have to hold a work permit where they're authorized to work in Canada, have 183 days or more validity remaining on their work permit. So when they buy the property, they have to have the permit that says, I've still got 183 days that I'm authorized to work. Okay. And they can't have previously purchased a residential property while this ban has been in effect. So you might qualify as a worker, but you can only do it once. You can't buy multiple properties while the ban is in effect. So people have to be careful of that. Again, we got to look at each fact situation on their own. And they have a definition of what's considered a purchase as well. So the purposes of this act, it's the acquisition, whether it's with conditions, without conditions, of a legal or equitable interest or a right or a real right in residential property. That's what is a purchase. And the issue comes up because there's pre-existing contracts that were in place prior to January 1, 2023. So if it was prior to January 23, it's not subject to this law. Where it became a little gray was, well, let's say you entered a contract prior to January 2023, but there was conditions still, and the conditions, fell into 2023. So that changes because now it's not a firm a deal. So that was an issue as well. And assumptions and assignments fall into these categories as well. We got to look at everything on a fact by fact situation. Now, there was exemptions and there's also exceptions. So these are exceptions when something would not be considered a purchase for the purposes of this act. Okay, so if someone acquired an interest because of the death or divorce or separation or a gift, it would not be considered to be a purchase. Okay, so if a foreigner, someone who's a non-Canadian, acquired a property because of the death or a gift or separation or something like that, they can acquire the property as long as that's real and there's evidence to substantiate that. So that's an exception. It won't be considered a purchase. The next one is the rental of a dwelling unit to a tenant for the purpose of its occupation by a tenant. That's not a purchase. That's a lease transaction. If the transfer is done under the terms of a trust that was created prior to the date this law came into force in January 1st, 2023, that could be an exception that wouldn't be considered a purchase. Another one is the transfers resulting from the exercise of a security interest or secured right by a secured creditor. So if a secured creditor is taking over a property because of a default by the debtor, then it wouldn't be considered a transfer. So you could have a non-Canadian secured creditor that acquires a residential property because they've exercised a foreclosure on that or something to that effect. It wouldn't be considered a purchase under that. That would be prohibited. And if the last one is that the property is being acquired for the purposes of development. So there could be an exception, won't be considered a purchase if the facts fall under that. And now you really have to pay attention to some of these enforcement and penalty provisions that they put in there because they made it comprehensive and they want to go after everybody and anybody that might be party to a transaction and come up with or be part of any scheme to try and get around this foreign buyer ban. So it's anyone who knowingly counsels, induces, aids, or abets a contravention, okay, by a non-Canadian or attempts to do that is guilty of an offense and is liable to a fine of up to $10,000. And if a corporation commits the offense, the directors, officers, managers, etc., who authorized this or acquiesced or participated in this can be personally liable. Each one of them, if there's more than one, can be personally liable for $10,000. So the potential liability, and this is what you have to pay attention to, the potential liability could be to a developer, it could be to the vendor, it could be an assignor, it could be me as the lawyer, it could be other professional advisors, it could be you as the real estate agent, notaries, mortgage brokers, anybody that was involved in the whole process. Okay, and I've read the Riot Act here to our staff too, because we have clerks that are very involved on transactions and dealing with it. You know, a clerk can be in my office can be personally liable in addition to me as the lawyer being found liable if we're trying to help someone get around this law. And the same thing applies in your office. If you're the agent and you drag in Sabiha to get some advice from her on this, and she says, well, if you can try and do this, you try and do that. And now all of a sudden she might be caught up in this. They might determine that she aided or abetted or attempted to aid or abet somebody in trying to get around this. So she could be personally liable for $10,000 and you as the agent could, and me as a lawyer could, and they all could. So they're telling us all, be very careful. I'm glad I'm not on the receiving end of that. I don't know what that was. Anyways, just be careful, okay? That doesn't mean we can't advise our clients and guide them through it, but you've got to be careful you're not crossing the line. You might help to see if they fit under one of these exemptions or exceptions and their facts fit, but don't try and be creative and try and make them fit when they don't, because you can be personally liable for fines and things like this. So you got to be careful. So that creates a potential conflict, okay? You discover that a purchaser under a binding contract is a non-Canadian. Now what do you do? Okay. You're trying, you know, and you have a conflict. I have potential conflict if I find that out. It's like we want to complete the transaction. If we don't, we're in breach of a contract. But if we do that and help them close the transaction, we're actually personally committing an offense under the act and can be personally liable. So that creates quite a conflict, okay? And to refuse to complete or advise on the completion is a breach of professional obligations. So it really creates a big conflict when that happens. So we all want anybody that we think is a non-Canadian not to enter into any binding agreement of purchase and sale while this ban is in place, because it's not going to do anybody any good. Not the buyer, because it's going to be overturned and they're not going to end up at the property, and certainly not you as the agent, not me as the lawyer, or anybody else that's involved in the process. So there are steps that we can take to avoid knowingly assist and willful blindness, because willful blindness doesn't help you as a defense. You can't be willfully blind. You can't pretend, you can't sort of think in the background, I think they're non-Canadian. I don't want to ask any of the questions. I'm going to put my head in the sand and not do my job properly. Okay. So that's why we want there to be reps and warranties from buyers in an agreement of purchase and sale. If a buyer is a
David, we
non-Canadian,
can we have a Schedule B that we attach to all our listings. I think it's
right,
prudent to put this in there, right?
right. And this, but this is, I'm just explaining the reason why we want that in there. We want any buyer to state in their agreement, I'm not subject to this foreign buyer ban. Okay. I rep and warrant that I'm not a non-Canadian. Okay. Because if any buyer that wouldn't sign that, that's going to tell you something. Okay. But so we don't want non-Canadians to enter into agreements of purchase and sale. It doesn't serve anybody any purpose. We want them to comply. Otherwise, we're going to get in trouble as lawyers and the agents on the file. Okay. So we want that built right into an agreement of purchase and sale. And Sabiha's got the clause. I don't know if I have that clause in my material here or not, but Sabiha will make it available to
So
you.
I was just thinking that we should have one for the Schedule B, which goes with our listings, and we should put it in our Schedule A's for all offers that we're putting for buyers.
Yeah. Okay. But keep in mind your role, and I have the same issue. We're on this. We're acting for buyer. We have to ask the right questions and make reasonable inquiries and not pretend that we don't know something when we do know something. Okay. So if a property is purchased in contravention of the act, the ministry will go to get a court order to undo the transaction. Okay. And the court order can require the sale of the property and take it away from that non-Canadian. Okay. And they've got pretty big leeway to do that. And then there's cost recovery and things like that. So, the proceeds that the non-Canadian could be, paid into court, the transaction is going to get unwound and redone. Okay. So it's not a good process for you to be involved in. So ask the right questions. Couple other reminders before I open up for some questions here. This has nothing to do with the NRST. The NRST is the non-resident speculation tax. So that is a provincial law that applies to non-residents. Okay, it's got different definitions. It applies to what someone that's defined as a non-resident under that. And that's not preventing a non-resident from buying a property in Ontario. It's saying non-residents are allowed to buy, but they have to pay a tax because they're a non-resident under the definitions under that law. So it's a little bit different. And then there's been
David,
amendments to that law.
is this non-residents of Ontario or
Yes,
non-residents of Canada?
non-resident. Yeah, it's an Ontario law. It's non-resident under the definitions of what's a non-resident that are specifically defined in that. Okay,
So
but it's
not a non-resident of Ontario, but a non-resident of Canada.
non-resident of Canada, right?
Oh,
But buying up property in Ontario. Okay. And originally when this came in 2022, it was a 15% tax, and it was only for a certain part of the province that was called the Greater Golden Horseshoe. And then later, they changed it to make it 20% of the purchase price and made it anywhere in Canada. And then they increased it again in October of 2022 up to 25% is the tax rate, and it's still applicable to anywhere in Canada. So someone that's determined to be a non-resident under this law is allowed to buy, but they have to pay 25% tax on it. And obviously this is just also residential properties. And then there's definitions of what's a residence, not residential, etc. So we have to look at that act as well. So I'll give you a little bit of a refresher here. So the NRST is, people subject to it. It's individuals who are not Canadian citizens or PRs, permanent residents of Canada. If you're a foreign corporation or if you're a taxable trustee, then you're subject to this tax. And this applies to residential properties that contain at least one and not more than 6 single-family residences. Okay, so the definition of what's a residence is different under this than it is under the foreign buyer ban, where it was like 3 units, but here it's up to 6 units. Okay, so a different threshold, different definitions. So we have to look at each fact situation separately. And under NRST, there's also certain exemptions that were built in. You could be exempted if you're a nominee, if you're a refugee, if there's a certain spousal exemption you might qualify for. And there was also rebates. So the rebates is you have to pay the NRST, you have to pay the tax on closing to the government. But if you fall under one of the rebates, you can recover the tax that you paid if your facts turn out that you're eligible to recover it. And one of them is a international student rebate. The other one is someone working under a working permit. So if the facts are right, you may have paid the tax on closing, but after closing, you might qualify to get it rebate and get the money back from the government under that law. Okay. Again, my apologies. There's no quick and easy answers. When we get involved or get asked involved in any of these things, whether it's foreign buyer ban, NRST, even vacant home tax, we have to look at every fact situation on its own and see, do they fit under the various definitions, number one, and then if they do, is there an exemption available? Is there an exception available? Is there a rebate available, etc. Now, when you combine the foreign buyer ban and then the NRST, there's certain people that might be banned under the foreign buyer ban, but let's say they have an exemption available to them or an exception, so they're allowed to buy a residential property even during the ban, and they're buying that property in Ontario, they might be subject to the NRST. So we have to go through both those processes. First, to figure out whether they can buy it, and if they can, are they going to be subject to the NRST based on the definitions under the provincial law for NRST? So they might be allowed to buy a residential property in Ontario, but they may have to pay that 25% tax unless they qualify for an exemption or exception under the NRST law, or they might pay it, and maybe they qualify after closing to get a rebate back. So it gets pretty complicated. Which is why I'm saying that, like, there's no quick and easy answer. Every fact situation we have to look at on its own and figure that out. Okay, so I'm going to throw it back to you, Sabiha. I did my best to cover all
I
this.
just wanted to point out that even though we realize that there is a ban right now, but anybody that has sold a property, especially adhering to pre-construction, and they would be closing at a later date, remember that your clients can close, but they will have, depending on which date that closing happened, the tax will be applicable to them. So it's prudent for you to remind them of that, because that is something that they will need extra in their pockets. And David, I will bother you for 3 clauses. One for the purchase
Yeah,
and sale agreement uh,
yeah, I'll
going in
send
the
this over
Schedule
to
B,
you.
another one going in the Schedule A when we're representing the buyer and the seller. Maybe it's good to put it in both. And that would be great. Anybody has any other questions? I see Regina had a question. She said, would the extra tax be covered by title insurance? David, I would let you
That's a
answer that.
great question, because there is some coverage for title insurance as long as we've provided all the accurate information at the time of the transaction, right? So you can't knowingly conceal certain information that a title insurer would want to know, and that's available. And then because we're going to claim title insurance for it later on, but there is some limited coverage they're not going to cover you if you sold a property to, I don't know if, maybe I'm not sure if I got the question right. If a foreigner that was banned bought it, you're not going to, title insurance is not going to help you out with anything. There's some title insurance coverage on the vacant home tax for
Yeah, I think
misfiling.
this was relating to the first part of the
Okay.
webinar. Yes. Yeah.
Yeah.
I think Hamza, you have a question. Please go ahead.
Just with regards to non-Canadian purchases or just non-Canadian transactions. So with corporations based in Canada, how does that work with like holding corporations? Is that not a thing anymore?
Uh, Sorry, the corporations, you're talking about the foreign buyer ban?
Yes, that's correct.
Yeah, so corporations are subject to it as well. So if a corporation is incorporated outside of Canada, they're considered non-Canadian. If it's incorporated in Canada, but it's controlled, and it's in control in hash marks, defined term controlled by a non-Canadian, then it's considered to be a non-Canadian and it's banned. And then you have to look under the definitions, the various definitions of control, to determine whether or not the corporation is actually controlled by non-Canadians. If it is determined, then they can't buy. That's, that would be too easy a way for someone to buy in Canada. The same way you also can't have you can't get a Canadian who would otherwise qualify and could buy their own residential property. You can't get a Canadian and say, hey, do me a favor, buy this property in trust for me, hold this in trust for me. Because I'm not allowed to buy a property. So
Sure.
that's not allowed either. You can't buy a property in trust for a non-Canadian.
Okay, that's fine. So I could essentially set up my own corporation and still continue buying properties if that was the case.
Yeah, as long as you're Canadian and the company that you incorporate is controlled by Canadian.
Now, if you had a corporation and again, it met like the less than 10%, I think it was the voting rights was less than 10%,
Yeah.
and then the equity structure less than 10% of ownership,
Yeah.
it'd still be fine under those circumstances, I
Yeah, then you're
assume.
probably okay. But you got to make
Oh,
sure that that's all it is. You can't, same thing, you can't say, you know what, I know you're really acquiring a 50% interest in this, 50% of the shares in this company, but I'm only going to give you 8% on paper because we want you to have less than 10, and I'm going to hold the other 42% in trust for you, right? That's going to get caught.
sure. Okay, thank you.
So, David, this was extended, the foreign investors ban from the 2 year originally.
Yes.
Um, uh, is there any talks of it at all being scrapped, or do we know of anything that's, or no?
Mostly when I talk about it, being, hopefully it gets scrapped. But right now, from what I've heard, like, the current federal government wants this in place. I'm not sure. You never know if there was an election tomorrow. Like they would campaign. This has happened before. They could, I'm sure the conservatives and the NDP would campaign against it, saying, "Oh, we're going to get rid of this," and then one of them takes power, and they might say, "You know what? We had second thought, and we're going to leave this in place." Like that happened with NRST. It wasn't the current provincial government that brought it. It was the Liberals that brought it in, and the conservatives were all over it, criticizing it, and they took power, and they go, "You know what? We got pretty good revenue from this NRST thing. Let's
Keep it,
increase it. Let's not just keep it. Let's move it up
25.
25%." That's not what they were saying when they were in opposition. But when they looked at it, they go, you know what? It's we're collecting a lot of tax here. So
Yeah,
you never know.
we had someone that plan not clients yet, but somebody that would have been a potential client for the brokerage just last week, and the husband and wife both have great jobs. They've just moved from US. But they're not able to purchase. Like I got this question from our realtor, and he kept on asking me, but they have a job. And I was like, yep, I understand, but
Yeah.
it's crazy. They have 3 kids, like they have to rent for God knows how long, right? 5 years if
Yeah.
they stay in Canada.
Yeah.
Yeah.
Like it doesn't, this doesn't make a lot of sense to me, but but there's some, when the market was really hot, that's when this was being introduced, and they were thinking, foreigners must be driving up the cost because they're just investing, and not only investing, but the foreigners are investing and they buy properties and then they don't use it, and they're sitting there empty. So now we want to ban them from buying it, and if there are properties that are vacant, we want to tax them. So we have the underused housing tax, and the cities come in. I'm not sure if there's a proper study that shows that that's in fact what's going on, and that was the driving force between creating the type of market that we were in with multi offers everywhere. We know that people like to live in the GTA. People don't like to move out of the GTA. We need more housing in the GTA. They're not building it fast enough. So there's always a demand. There's always, and because there's a demand, the prices get pushed up. So how are they going to cool off that market? Provincial governments, let's do the NRP, let's tax it. That'll stop them. Well, no, the foreigners were happy to pay the tax. It was still a good investment for them, whether it was vacant or they rented it out. They still bought the properties, but the government collected a tax. They said, okay, it didn't slow the market down, but the good news is we're collecting all this tax revenue, so that's good. So they, instead of abolishing it, they increased the tax.
Yeah, but my problem is when they're not letting people with jobs or that are going to university purchase, right? So the NRST doesn't really apply to them because they're residents, but the ban does. And that kind of, I think, is going to be sort of a drain on our economy as well, right? Because like people, if they find out, and there are a lot of people that accept jobs here, they come here, but they're not able to buy, not
Right.
realizing that they're not able to buy. They don't get into the nitty-gritty of the laws here. Nobody would think that, that would be a problem if you have a job to buy a property here, because nobody thinks of Canada as a closed market.
Right. So, and I don't know how this ends. Like, what happens on January 1, 2027? Like, do they say, like, do they make a declaration? Oh, everybody that wanted to buy a property in the last 5 years, every Canadian that wanted to buy a property has now had 5 years with the foreigners being out of it. So everybody, could have or did. So therefore, we don't need this law anymore. Like, I'm not sure how this ends. But anyways, don't shoot the messenger. I can only tell you what we have to deal with until it changes.
Yeah. No, Jeff has a question. I'm not sure if you have time for it, but he says, what if they added another tax for non-Canadians to buy? Or instead of the NRST, just have a tax. Yeah, that could be
Or yeah,
something.
instead of a prohibition,
Yeah.
instead of a ban on them buying, they do it like the NRST on a federal level and say, okay, we're allowing foreigners to buy, but you have to pay an additional tax to do that.
Mm.
At some point, you'd think the tax would be high enough that the foreigners wouldn't want to pay it. But the reality is, Canada is a great place for some people from certain countries to get their money into. It's safer for their money to be here. So even if they have to pay a tax, they'll still do it because they want their money out of some other country, and they want the money invested here. And with the real estate market, eventually it'll be worth what they paid, including the tax. So bigger heads than mine have to figure this out.
Yep. All right. Thank you, everybody, for joining. Thank you, David.
Okay.
Amazing session.
Thank you, everybody.